morning, everybody. I think we're about finished with breakfast. We're going to get started. So welcome to Cotton's Autumn Budget Debrief. The first thing I've been asked to tell you is that you can all move your chairs now. I think a lot of you are going to struggle to see the screens unless you sort of move out or move around, or we don't want anybody straining their necks and backs and whatever else. Good stuff. Right, so great to see so many people here today. I think that's a product of how highly anticipated this budget's been. Either that or you've all Googled how good the breakfast is here, because I did just have a very nice breakfast. But yeah, we're very excited, or these guys are, to finally be able to know what was in the budget, be able to digest it all, turn it into a presentation, and hopefully give you all the information you are here today to receive. So those of you who don't already know me, my name is Emma Reid, and I am one of the partners here at Cotton's Group, and I'm based out of the Rugby office. My job here today is the really easy bit. Out of all of us stood here today, I just have to intro and do a bit of housekeeping, so I'm quite happy. So I understand, hang on, how do I work this? There you go. I understand that we have a wide range of people here today, from clients, staff, and our professional contacts. But not all of you are currently working with Cottons or have worked with Cottons before. So it's just for me to tell you a little bit of background as to who we are. So Cottons is a mid-tier general practice accounting firm. We entered the top 100 this year. We have 13 partners, around 110 staff. Geographically, we are mainly spread across the Midlands, although our presence heads all the way down to London. In terms of who we work with, we predominantly work with owner-managed businesses and individuals, but actually we don't specify in any particular industry. We work with everyone and everything, really. Our services, so what do we do beyond accounts preparation and tax return preparation, which may be what you know us for? A whole load of things, which are all listed here. I'm not going to go through them one by one, because you are going to get a copy of these slides later. But what we're here to do today is to present our tax advisory services. So just a little bit of housekeeping. I understand we're not expecting a fire drill, so if the fire alarm does go off, we need to leave through the fire exit at the back in an orderly fashion. Questions and answers. So we really want your questions. These guys can't wait to see what you're going to come up with and put them on the spot with. However, we do ask if you could just save them to the end, because we are going to have a Q&A session. On everybody's table is a QR code. If you aren't somebody that wants to put your hand up at the end with your question, you can scan that throughout the event and you can type your question in. It might be a good idea if one pops into your head quite early on and you don't want to forget it. You can use the QR code, get your question submitted, and it's going to come through to us and we'll answer it later. We would ask you please not to record this session. However, if people want to take photos and post them on LinkedIn and tag us, we're always keen for that. But no recording, please. You may have noticed already today that there are plenty of Cotton staff here today. Some of them wearing their branded tops, so you can spot them. There's also at least 4 of the Cotton's partners here today, and obviously the people here from the tax team presenting. So please do grab us afterwards if you've got any questions about anything you've heard today or anything you'd like to follow up on, or anything else in the world of accountancy and taxation. I think that's my very easy job done. I'm going to pass you to Jo.
Oh, good grief. Okay. Now, I will apologise up front. I'm not really very technologically minded, so if I press the wrong button, please do bear with me. So I'm Jo Surley. I am Director of the Private Client Group. I've actually only been with Cottons for 2 months. so most of you probably won't know me. I have been advising private client owner managers, which includes farmers, for the past 30 years. So quite a lot of experience. And today I'm just going to be doing a general overview of the personal tax matters that came up in the budget. And then we'll be going into more detail with Luke and Dan talking following myself. So we'll start the slide with a quote. So some of you may have heard this quote: "For a nation to try and tax itself into prosperity is like a man standing in a bucket and trying to lift himself up." I don't know if any of you have tried this, but I'm quite embarrassed to say that I have. And the outcome generally is you go nowhere, or you fall over and end up looking a little bit silly and embarrassed. So where we'll actually end up, only time will tell. Obviously, not everybody is going to be adversely impacted by the budget. There will be winners and losers, but there is certainly a lot in this budget to make owner managers and those with land have some thought and possibly take some advice. So the OBR, since the budget has come out and said that there will be a short-term sugar rush, so all the debt finance spending that was mentioned in the budget will provide a sugar rush. I think we're expecting interest rates to be reduced by the Bank of England in the short term, but then they've predicted by the end of this Parliament, it is likely we will all be moderately worse off. Now, I don't know how they measure moderately. I'm hoping it's my measurement of moderately, but they've certainly said that inflation will be slightly higher, interest rates will be slightly higher than otherwise would have been the case. So that will generally impact all of us, especially if you've got mortgages and things like that. So this is the first budget I can remember in all my years where there has been so much hype beforehand. I mean, I don't think I've ever experienced anything like it before, where there was so much out there about what could happen, and all of those things being extremes. And it's probably, we were expecting capital gains tax and dividend tax to be aligned with income tax, talk about agricultural property relief and business property relief being abolished completely. We thought something would happen to pensions, that they might be a flat rate in terms of relief, and maybe withdrawing the lifetime allowance. We even expected changes to national insurance and stamp duty, but probably not quite the changes that we got. So when we were watching the budget, as we do every year, it's again the first budget I can remember where at the end we actually all sat there and went, phew, that's not as bad as we thought it was going to be, which is quite surprising when in normal times, had we had an 8% increase in a basic rate of capital gains tax, or a national insurance rise of 1.2%, put in place at the same time as reducing the employer's threshold, we would have been thinking, actually, this is quite significant. And I think it is significant. And the key message I would like to get out to all of you today is to talk to your advisors. Talking is key so that you can understand your position, because it's likely it will impact most people in this room. And I believe we have some intermediaries in this room. If you are an intermediary, it's likely to impact your clients. So what did we have? What actually happened? So we had the capital gains tax rates that went up immediately, from 10 to 18% for a basic rate taxpayer, 20 to 24% for a higher rate taxpayer. Basically, those rates were aligning the capital gains tax rates with rates for residential property. Carried interest was also increased. Not many people have carried interest, so I won't go into the detail on that. If you have, please talk to us, because there are some significant changes in the next couple of years there. And business asset disposal relief. So basically the tax relief when you sell a business asset is increasing from next April. That does provide some opportunity, and I think Luke is going to be covering that in his talk. So that time lag there, I say, does provide some opportunity for business owners. And a big one, which we hear very little about, is investors' relief. Investors relief was sort of like the old entrepreneurs relief and business asset disposal relief, but it was for third-party investors into your business. They could get 10% tax rate on 10 million. It's now been reduced to 1 million and brought in line with business asset disposal relief. Dividends, no changes. In fact, it was the only area where we're anticipating a change where there was none. Pensions, Dan's going to go into this in more detail in his speech, but there has been proposed an inheritance tax on pensions, on inherited pensions, just to say that that now is under HMRC consultation. So what that means is there'll be discussions around that from the industry with HMRC, and then what actually comes into place will be decided following that. So it might not happen in the way it's been proposed in the budget speech, Rachel Reeves' speech. National insurance. Now, national insurance is a big one. This is raising £25 billion out of the 40, which that number in itself should tell you just how significant this change is. The government are right, it will not impact your very small employers. In fact, they might be slightly better off because they've increased the employer's allowance. But for growing businesses and the majority of businesses that we deal with, this will have a significant impact. So I would be advising everybody to look at their budgets and reassess sort of what their payroll costs are going to be. Stamp duty land tax was increased again immediately on second homes, 2%. This has already had an impact on the market, and it'll be interesting to see what happens going forward. And then a big one for probably many people in this room is actually the changes in inheritance tax rules, where agricultural property relief and business property relief has a restriction of 100% relief on 1 million. Now, £1 million might seem a lot of money to some people, but when you have land and a business, a thriving business, it doesn't take long before that 1 million is breached. And that is a combined 100% of 1 million. So that's combined business and agricultural relief. So the big things that weren't really a surprise. So we've got the national insurance increase, which is significant because it is raising 25 billion. So it is going to impact a lot of businesses and will impact the market. So it is likely pay rises, and this has already been acknowledged by the government. Pay rises will not be at the level they might have been without this, and actually recruitment in some companies might stop for a while whilst they take on these costs and make the money to cover them. VAT on private school fees. Now this, again, no surprise, if you've got children, grandchildren in private school, that increase will be coming in from January. Unfortunately, there's not a lot of planning currently around private school fees, and indeed the government have said anybody that tries to avoid VAT on private school fees, they will deem that as tax avoidance. So we just need to be careful. If anyone comes to you with a clever idea on private school fees, please make sure you take advice. What we don't want you to be doing is something that would deem to be tax avoidance. There is planning out there. You can do wealth planning, you can do sort of asset planning. So there are things out there that can be done, but just take care on those. Oh, sorry. So other changes, some you'll already know about. High income child benefit charge, that changed this year in terms of the thresholds. And from next year, if you do claim that, then it'll be in your pay as you earn code. Stamp duty. So not only do we have the 2% on additional properties, but what a lot of you might not realise is that from April, the stamp duty thresholds revert back to the, I think it's 2022 rates, where stamp duty starts to be paid at 125,000 rather than 250. So that is a significant change. So if you're looking to buy property generally, then you just need to take that into consideration, that from April, the amount you'll pay will go up. And again, it's for first-time buyers, the rate is going back to 300,000. Non-DOMs, we're not planning to talk about non-DOMs today. It's very specialised. If you have got non-dom status, then obviously speak to us afterwards. But those rules are being abolished from April 2025. And to be honest, it's one of those rules where we were quite unusual as a country to have a non-dom status. It's not really widely recognised across the world. We are one of the few nations that had that. And then furnished holiday lets. If you have furnished holiday lets from next April, they will no longer be a business. So this will be significant if you have one of the have furnished holiday lets. So interest relief on mortgages will be restricted from that date. Capital allowances on new assets will no longer be available. You can continue to claim capital allowances on existing pools. And a big one is profits will no longer be earnings for pension purposes. So this is just confirming that, you know, holiday lets are not deemed businesses, and therefore the profits you get from those will not be earnings for pension purposes. Also reliefs such as the capital gains tax reliefs, which were available because they were businesses. So that's business asset disposal relief, holdover and rollover relief, where you can defer the gains. They're also abolished from April. So on the theme of property, I don't expect you to be able to read this slide. So if you're sat there thinking that writing's too small, this is purely illustrative to show you that over the past, it starts in April 2013, but actually it's past 15 years, there have been over 20 changes in property tax rules. Ones before April 13 were sort of to do with stamp duty and also council tax. This slide doesn't include any council tax changes or any regulation changes in terms of health and safety and things like that. So it's just to show you that property has been probably a difficult market to be in. People have done well out of it, and people will continue to do well, and there will be likely further changes going forward. But the latest one being the stamp duty rise on additional properties, which will affect landlords, property investors, and second home buyers. And then we already know there's a couple coming in next April, which is stamp duty thresholds reverting, and also the furnished holiday lets. So it's really just to let you know that if you've got property, there's a lot going on. And again, I will be repeating myself continually. Please talk to your advisors. So in terms of stamp duty, this is actually a client scenario, albeit I have changed names, just to show the impact. And this impact will be the same whether you're an individual or whether you're a property investor. But Catherine Wheel was looking to move house, to be near her son, to help look after the grandchildren. She's had problems selling her home. And again, we're seeing this more and more frequently because of the flood risk. It's near a river, and there's also planning on land nearby for a new solar farm. She did have, sorry, there was something flashed up on my screen, which did not come up on yours. So she did have a budget for $480,000 to buy the property, which took into account all her costs. So the purchase price of $450,000, agents' fees, $6,750, the stamp duty cost, which was $23,500. So the total cost $480,000. She was due to complete on the 1st of November. Now, normally most tax changes come in from the start of a tax year, or you at least get a little bit of notice. You know, even on school fees, whilst we don't like it, there has been a little bit of notice on that. Whereas this happened instantly. And therefore, Catherine's bill for buying this, cost for buying this property increased by £9,000 overnight. And unfortunately, she could no longer afford to buy that property. So she's pulled out of the market and is now reassessing her options. So anybody looking to buy another property, any property investors, you should be reviewing your budgets to make sure you understand the impact of the stamp duty changes which are coming in. Now what could potentially she do? Unfortunately, in terms of stamp duty, there is very little you can do to plan against stamp duty. It is what it is. But so, as I say, existing property investors, review your budgets. Those of you who might be thinking about entering the property market might want to look for an alternative. So there's real estate investment trust. I don't know how you pronounce it as a word, REITs. But real estate investment trusts are a way of investing in property, but it's an indirect investment. You don't actually own the property yourself. So it gives you that exposure to the market, but without the direct ownership. And if you are replacing your main home, make sure you apply for that stamp duty refund if you sell your home within the 3 years, the original home. A lot of people miss this, so they pay the stamp duty, they then sell their actual original home within a couple of years, and they forget to go back and actually claim that additional stamp duty back. So if you're in that position, speak to your advisors and we can do that. Generally, solicitors will pass that work through to us to deal with. But again, you can chat with your solicitors with that as well. But just make sure you take advice is the answer. So the big ones really, the other questions we're getting and having a lot of discussions on, and we will talk through this in more detail. Luke will go through, I think, this in a little bit more detail, is agricultural and business property relief. This is going to have a significant impact on some individuals' estates. So currently, under current rules, there's unlimited relief if the conditions were met. Again, I'm not expecting you to read this slide. You will get a copy of it afterwards. But basically now it's 100% relief for the first 1 million combined business and agricultural property, and then 50% relief on assets over 1 million. You cannot transfer your unused relief to a spouse or civil partner. Now that in itself will open up some planning opportunities. So some of you might remember many years ago, it might not be that many years ago, but many years ago, you never used to be able to transfer the nil rate ban for inheritance tax purposes, the 325,000. It used to be use it or lose it. And this is basically similar. And in the olden days, I'm going to call it, we would do planning where we made sure that those reliefs were utilised. So it might be if you have business property in your own name or agricultural land in your own name, you know, we might be looking to transfer it to the spouse and then do some planning on making sure that both of those, you both get £1 million worth of relief rather than just one of you getting £1 million. So that there are opportunities there. We shouldn't be doing knee-jerk planning though. So the important thing is to talk to somebody and understand your position. So the rules, I say, are basically similar. If you had assets or have assets that only qualified for 50% relief currently, then those assets will still be 50% and they won't be able to fall into the 100% band. So again, the importance of actually having your position looked at, it is going to become quite critical going forward. So again, this is a scenario. I've used a trading business, but it would be similar for landowners. So I've got Mr. Fawkes, has been trading for many years as a demolition operative through his company, Parliamentary Demolition Limited. The business has been successful. I'd like to say thank you to my colleagues, though, for giving me these names. I can't take any sort of credit for them. They were given to me. My slides were a little bit more boring than this. And he has a business which he wanted to pass to his children, Guy and Efi, on his death. And this is quite a normal scenario for succession planning. His wife has passed away some years ago, so there's no planning we can do there. And the company is currently valued at £3.5 million, which again is not unusual for our client base. Some clients have lower business values, some a lot higher, but it's a reasonable amount. So should Mr. Fawkes pass away before the legislation is introduced, he'd have no inheritance tax liability, as it would be fully covered by business property relief. And that would be similar if it was land. It's potential that he'd have no liability because it might all be covered by agricultural property relief. However, when these rules come in, if they come in their current form, and again, only time will tell if that will actually happen. As I dare say, there's going to be a little bit of backlash to this legislation. Then from April 2026, he will actually have a liability of £500,000, or his estate will have a liability of £500,000, which will need to be paid. Now, generally, not all businesses are cash rich, and certainly for landowners, farmers are even less likely to be cash rich. So where do they find the money from to pay that? That money will have to be realised from assets held. That assets might be the shares in the family business. It might be land that's currently owned, but it will have to be found from somewhere. HMRC have said that you can pay it over 10 years, which is the normal rules for inheritance tax, that there is a payment window of 10 years if you can't afford to pay it in one go, but interest will accrue on that. And actually, most people don't wish to pay inheritance tax over 10 years because the estate's not actually fully dealt with until that window is over, and it's a burden to have over your heads. And also, we could be talking significant sums that still need to be found every year. So what can you do? So in terms of inheritance tax planning, these are some of the things that potentially could be done. So for a business and agricultural property, understand your exposure and potentially consider some lifetime planning. What that planning will be will depend on your current circumstances, but there is, basically the message is there is potential planning out there. So it might involve gifting assets now in lifetime, it might involve transferring assets to the spouse, but just understand your position. Understand the impact of pensions on your estate. Now, due to the consultation, this slide was written before the consultation started, then our advice would probably be, and Dan will go into this in more detail, is that actually we wait and see what that consultation gives us to see actually what you could do. But there is on the slide a couple of ideas that were in the market on how you could mitigate the impact of those pension reliefs. And generally, looking at inheritance tax planning, actually plan, do the basics, use the reliefs that are available, and consider, potentially gifting assets. There is a widely unused relief, gifts out of income. So you do need surplus income, and there are various conditions to be met. But if you are in that circumstance, then you could stop your estate from growing. It doesn't reduce your estate because it's out of income, but it could help mitigate your exposure. And if you've got trusts, review those trusts. And note at the bottom, it's really important in terms of pensions or investments such as real estate investment trusts, speak to your financial advisor. That's not something that we as tax advisors can give advice on. The other big thing that's come up is capital gains tax and the changes there. So what can be done to reduce capital gains tax and the implications of the rises that are coming? So again, you could realise losses. If you have assets sat on losses, you could realise these to reduce and to offset those losses against the chargeable gain. You could make investments into something like an enterprise investment scheme or the seed enterprise investment scheme. These are very high risk investments, though, I would add. And again, you must talk to someone like Dan if you are thinking of that, but they can effectively defer or exempt a capital gain. But as I say, they are very high risk because they're in startup. EIS and SDIS are startup companies. Generally, consider transfers to spouses and civil partners. I've already mentioned that briefly, but spousal transfers are tax exempt. There's no tax implications, so that's normally a good one for maximising reliefs. For business assets, might be that some people start considering making disposals now to realise sort of the business asset disposal relief, lower tax rates, and actually just start doing it now. We are expecting, and again, Luke is going to talk about this, we are expecting some activity in the market on business sales as a result of the timing of various reliefs and the staggered increase in tax. Or you could do nothing. People underrate doing nothing. But if anyone has spoken to me recently, sometimes you'll hear me say that actually taking advice and then that advice being do nothing is actually good advice and it's valuable advice. I do have people saying, why would I pay for advice if all you're going to come out with is do nothing. Well, I would say to that at least you know doing nothing is the right thing to do for your circumstances. Also, capital gains tax in particular is considered a voluntary tax. And it's considered voluntary because you can control the timing of that tax, and therefore you can wait till you have losses to offset. You can do partial transfers and gifts, or you can wait till tax rates change. But the key is, again, understand what your exposure is. Unfortunately, we can't go through every scenario in the time we've got. So do talk to us and understand what your options may be. Now this, I'm going to apologise if anybody's a Tigers fan. This is really just to get a message across, my key message for today. And I was trying to find, going back to basics, and something that would actually demonstrate that. And what I could find is actually the Northampton Saints. That is my son. So I'm not breaking any sort of safeguarding issues. In that child is basically teaching the basics, and doing the basics is what actually gets results. So in terms of the SAFEs, it's catch, pass, score, and that's what they teach them from a very young age. And going through the academy, that's the thing they're doing over and over again to try and get that fast game the Saints like to play. So for us, our equivalent is actually talk, plan, action. So talk to us, understand your position. Knowledge is key. You don't know what you don't know, and therefore the more knowledge you have, the more you talk to us, the more we can be proactive and help you. Plan. Consider the basics, have a plan, and make sure those basics are looked at. All too often we get people coming to us saying, I have a friend, they've done this, or the man in the pub's told me this, and yeah, we find that actually it doesn't quite suit their circumstances, and it's not the best thing to do, and it's overcomplicated. So consider the basics, have a plan, then take action. That action, as I say, might be doing nothing, or it might be having a plan to implement certain bits of planning. If you don't understand any planning that's recommended to you, don't do it. Don't do any planning that's complicated and you don't understand. The planning is for you, and you need to understand it. Therefore, your advisor should be able to explain it to you in a way that you do understand. All too often, we get clients that have actually taken action, then they come and talk to us, and then actually we're planning to try and unravel what they've already done. So we just need to turn that around. So the action is talk to us, let's make a plan, and then we'll do whatever we need to do following that. So I'll now pass on to Luke, who will go into some things in a little bit more detail.
Thank you, Jo. Morning, everybody. My name's Luke Prout, and I'm a tax partner at Cottons Group. Like Jo, I've been here slightly longer than Jo, of about 4 weeks. But I joined. I was a partner at another firm for 6 years prior to joining, and I've trained within sort of top 20, top 15 firms throughout my career. Just picking up, I'm going to talk about inheritance tax very quickly before I go into the main bit of my slides, because my slides is more looking at the businesses. So we're looking at what the impact are for businesses. Obviously, being a corporate tax specialist, I always look at that towards the businesses. But in terms of the inheritance tax changes, we are, once the dust has settled, and we because what was announced in the budget last week, I think we may not see. We might see that being watered down slightly. If anything, like if you see, what the NFU have said, 75% of farmers are affected by this, not 25%. So I don't think it's been well thought. It was designed to catch out, Mr. Dyson. But unfortunately, a lot of other farmers have been sort of brought into that with them. So I do think there might be changes, but we are, as a firm, we're actually going to be running seminars early next year on this particular topic, because this topic is a topic in its own right, and it's very, very important. to a lot of our clients, not just farmers, but business owners too. And we do want to make sure that we run separate seminars next year. So that's something to look out for early next year, is on the inheritance tax side. Oh, got it wrong way around. So just extending on CGT, the CGT changes, and I'm not going through the rate changes again because Joe's kindly been through those, but I'm going to be looking at from a business point of view, and more importantly, business asset disposal relief, or what we call in the industry BAD relief, BADR. This is not a great relief. In fact, under the last Labour government, we had a fantastic relief called taper relief, which was very, very generous, no lifetime limits, and actually a lot more assets used to be able to sell in the early noughties, used to get the effective rate of 10%. It's been gradually watered down since then. The Conservatives watered it down a few years ago to where we ended up with £1 million of gains from the sale of business assets, and that could be shares in a trading company, or up until next year, furnished holiday lets qualify for business asset disposal relief. But interestingly, we was involved in a lot of transactions prior to the budget to get deals over the line prior to the budget to secure those beneficial capital gains rates, and quite rightly we did. My bet at the time is they were threatening an increase on the 30th of October, but then delay it until the next year because then they'll get another flurry of transactions in. That didn't quite happen, but I actually think they were quite clever in how they've done it. So as Joe said before, on budget day, the rates of CGT were increased immediately. But what they did is, in regards to the sale of assets that are business or business assets, so shares in your family company, you may be goodwill, furnished holiday lets, they kick that down the road until April next year, where that will increase to 14%, and then it will go, and then a further year's time that will go up to 18%. That was quite clever, because what that means is that's going to, for the Exchequer, that means we're going to see a lot of transactions with family companies over the next 6 months to secure effectively a 10% capital gain, a 10% rate before it goes up on the 14th, before it goes up next year. So from a planning point of view, if we're looking at family succession, so we're maybe looking at bringing the children into the business, and we may want to exit out the business, or we're looking at a sale of a business to a third party, or we're buying back some shares, and we're thinking we might do this within the next 2 to 3 years. Actually, the window is just shortened for you, and actually we want to be thinking about doing this now, and this will happen. Unlike the IHT changes, where there's quite a lot of backlash from it and there could be some watering down, this won't be watered down. This is happening and this will come into place. So therefore, between now and next year, we've got to be thinking about if we are looking at some succession planning between family businesses. So we want to exit. So management buyouts with the management team or your children. We want to be bringing those transactions forward into this tax year to secure these rates. I'm not going to go through investors' relief because Joe's just been through it. But again, just to add on to it, investors' relief is different to BAD relief on the basis that I would say it's the opposite. So it's where you invest in shares in a company that's not yours. So you could invest in your friend's company, put £10,000 into your friend's company, subscribe for shares. As long as you're not an employee or connected with him, you got this rate. It's a very underutilized relief. And actually, until when they made this announcement on budget day, I think a lot of tax practitioners forgot this even existed, because we did have a generous 10 million limit. Again, not going to go through VAT on private schools. The only thing I am going to mention is obviously we did have anti-forestalling rules. So paying your school fees in advance, that was touted as an option to get that rate over. Well, HMRC thought about that, and they did it put in anti-forestalling rules. So what that means is if you pay your school fees early, what they're going to do is they're going to charge VAT at the time that the supply is made, not when you make the deposit. So charge VAT at charge VAT. I will reiterate what Joe said before. There is planning we can do with clients and around school fees, but it has to be in regards to, I would say, wider wealth planning. There are options, but we have to be very, very careful on this because HMRC issued it's what we call their spotlights, which is where they think things are not being done things are not being done in spirit of the law. And they issued a spotlight on school fees a couple of years ago. So what I would say is if we are looking at school fees planning, it has to be bespoke for that particular client, particular circumstances. And we can't enter into a piece of planning just for school fees. It has to be for part of wider wealth planning. So, company cars. We got some new company car rates. We always get every year. Now we used to have a very zero emissions vehicles, so electric cars. We had an ultra low rate. That's increasing by 2 percentage points. So by 2029-30, the end of the Parliament, we'll have a top rate of 9% on electric cars, which is based on the list price. So if you've got an electric car list price, and it's 9% of the list price is what you will pay tax on. In the scheme of things, that's still very attractive, especially when we look at cars that have got emissions above than 50 grams per kilometre, which I'll come to in a moment, where the tax charge on that is very punitive. It's which we'll go through in a minute. Now, so electric cars still very, very tax efficient to have within your company, not just for the owner managers, but also for your employees. But what about if you want to tow a caravan? Electric cars are rubbish for that. So you might want to consider a hybrid. And actually with hybrid vehicles, again, there are lots and lots of hybrid vehicles on the market now where we've got CO2 emissions of less than 50 grams per kilometre, which then means actually we get a top rate by the end of the Parliament of 18%, which I still think is very, very palatable for a hybrid vehicle. The new VW Tiguan hybrid does 80 miles on its battery. Petrol hybrid, but I think the equivalent MPG is 712 miles per gallon. And that's got a list price of 40,000. So there's some really, really good hybrid cars out there. So you can benefit of the lower rate of employment tax, but then be able to travel to Scotland and not have to sit there for half an hour while your car's being charged up. Eating junk food that you wouldn't usually buy, but you've had to buy the junk food to wait for your car to be charged up. So also you lose weight as well. A couple of bits on capital allowances. So a little bit less relevant because of full expensing, but capital allowances on electric vehicles, you still get 100% write-off for an electric vehicle. So that's one of the plus points for an electric-only vehicle. For hybrid vehicles, you don't get 100% relief. So we do have to look at that. And when we terms to planning, clients often usually say to me, should I buy a car and lease a car? But actually my answer always, it depends. Because sometimes you would purchase a vehicle, be better off from a tax point of view and a residual point of view to purchase a vehicle. Some vehicles I would recommend actually you lease it. So for example, hybrid vehicles, I would recommend you lease that vehicle because of the tax relief that you will get for the lease payments over the capital allowances. Also, again, slightly electric charge points also get 100% reliefs. That's really aimed at, I would say, the electric charge point operators mainly purely because if you put electric charge point on your house or in your business premises, it most likely will fall into the annual investment allowance anyway. But these are for the sort of the very large infrastructure projects. Could talk a little bit about vans. So next couple of slides, we're talking about vans. So feel back. So I remember 20 years ago, the van rate was less than 500 quid. So if you had a van, you put 500 quid on your P11D, you pay tax at what was then 40%, and you could run a van as privately, and also the fuel charge was, and you could fuel it up and run it, and it was very tax efficient to have a van. Still now, white van man or lady, £4,000 a year is so in terms of from a tax point of view, it's still relatively good. But what about double cab pickups? Are they vans? Well, depends what time of the year it was. So back in January 2024, double cab pickups, and I will add that could carry a payload more than a ton, were classed as vans. Then in February 2024, HMRC decided, and it was following the case with Coca-Cola, decided that actually we're going to, from this point onwards, all double cab pickups are now cars, and obviously that meant from being vans being treated as cars, they no longer were taxed at this rate; they were taxed at company car rates, of which from 29.30 we're going to have a top rate of 39% of the list price. So just to put that into equivalent, over a 3-year term of a car, that's over 50 grams per kilometre, and it includes double cab pickups, which I'm going to go to in a minute. You're actually going to be paying 117% of the list price in tax. So very, very punitive. Oh, wrong way. So double cab pickups announced in the budget. They are now to be treated as cars, but we've got a little bit of planning to do. So double cab pickups with a payload of ton or more. So anything below a ton was always classed as a car. But double cab pickups now with a payload that can carry a ton or more from April 25 will now be classed as cars. What does that mean? Well, currently with double cab pickups classed as van, you can claim the VAT back if you're VAT registered and you're using it for your business. You can claim the annual investment allowance on a double cab pickup, so 100% tax write-off. The benefit in kind, it was taxed at the van rates. So double cab pickups were extremely attractive. And I remember as an audit trainee 22 years ago doing a stock take, and the four directors of the company all turned up in their double cab pickups because there was virtually no car tax on that, and that was an issue 22 years ago. So for me, this was a long time coming. It wasn't a case of if, it was when this would happen. And the HMRC haven't liked this for many, many years. So, but it is coming in. But the planning point from this is if you do, it is from April 25. So we've got transitional rules. So anything you've got now, it will continue to get it. And for the earlier of when you change the vehicle, when the lease ends, or I think 3 years. So if you've currently got double cab pickups, fine, no changes. But if you do change it and get another double cab pickup after April 25, then it does become a problem. But you've got till now in April. So if you are thinking of changing your vehicle, you need to get it done before April to continue to get the beneficial tax treatment. Corporation tax. So there was a corporation tax roadmap for the next 5 years. It's the only thing we've got stability on. So for the end of the Parliament, the 25% rate is remaining, and the small rate, so profits up to £50,000, will be there at 19%. Anything between 50,000 and 250,000 has a marginal rate of 26.5%. There's a little bit of planning we do in terms of profit levels, but corporation tax isn't changing. But then, who knows? Same with capital allowances. So we've got full expensing. So in terms of capital expenditure for your business, there is the security there that, and this is for businesses investing into the UK as well, to make sure that there's certainty there. So long-term investments by you into your businesses, and also businesses investing into the UK, there needs to be the long-term certainty. So corporation tax is changing, and so is research and development tax credits. So that's continuing. In fact, so nothing's changing for research and development tax credits. They are tightening regulations in terms of who can do an R&D claim, because there's a lot of abuse in the market. But in terms of the rates, they're still there. They're going to be continuing for the foreseeable future. We do lots of research and development tax credit claims with many of our clients. And I say it is the most generous tax relief, because it's one of the reliefs where actually for qualifying R&D work, you can receive physical cash payment from HMRC. So that's why it's attractive for business owners, but unfortunately, because you do get cash payments from HMRC, it has been open to abuse. Also, we sit on the right line of it. Lastly, I'm just going to go through EOTs, so it's just one last change. So an employee ownership trust, and I just want to mention this slightly. So employee ownership trusts are the John Lewis model. It's the employee-owned model, and you may have a business where, for example, if your buyers might not be easily identifiable. And one of the options you can do is actually sell to your employees and sell to an employee ownership trust. Why would you do that? Well, the main reason is if you sell to an employee ownership trust, there's no capital gains tax, providing there are lots of conditions, and providing those conditions continue to be met, which is now for 4 years after you sell the business, and there'll be no what's called clawback. But if you want to sell your business to an employee-owned, to an EOT, to your employees, and it can be an employee-run business, then there is a 0% CGT rate. So once the CGT rates go up post 5th of April, EOTs, which it's a very Labour thing, so I wasn't surprised they didn't abolish them, but I was more surprised actually they did retain the zero. It's actually not a 0% rate; it's actually a holdover relief, but that's a technical point. But there's no tax on a sale to an EOT, which it's still very, very generous. And that's me. So I'll pass it over to Dan.
Thanks, Luke.
Oh, you do? There you
go. Morning, everyone. So good to see so many people out today. So thanks for making the effort and coming out. Is everyone clear on what's going on with the budget? Everyone feel like they're clear as crystal or clear as mud? Yeah, exactly. Welcome to our world. So I think a key part of wealth management alongside accountancy advice is there's a huge overlap with what we're doing. So there's a lot of areas that I'm going to cover with you today, but I'm going to keep it quite high level at this stage, because what we want to do is encourage you guys to actually ask questions. I've got no two clients that I work with who are the same. So everyone will be impacted by some of these changes in different ways. So it's important, like Joe was saying before, it's never been as important to get advice as it is now. Having a financial advisor, I'm a chartered financial planner and an independent financial advisor alongside your accountant is very, very important. I've been working with Cottons Group now for about 10 years, been in the industry for just under 25 years, and there isn't anything out there that I haven't seen before. So any form of wealth, financial planning, any situation out there, I've worked with people with significant issues, multi-million-pound issues, down to average people in the streets who are dealing with day-to-day issues. And one of the issues that I have had with some of the decisions that have been made is that the media are creating a lot of fear and speculations. Everyone agree with that? Yeah, has everyone seen this? And did just straw poll in the room as well? Has anyone reacted to the media speculation? Because my phone has been ringing off the hook. Anyone put their hands up and say, has anyone rushed to take their tax-free cash from their pensions or anything like that? No? It's fine, I don't want to put anyone on the spot. I'm just interested. Because I've been asked by a lot of people. And what we've seen, unfortunately, as a result of a lot of the speculation is a lot of pension providers, for example, have said that they've seen a marked increase in people reacting to media speculation. Every time I've had a phone call from someone, can you hear me okay, by the way? Sorry, because I know when I turn my head, you get this. Sounds like you're at Formula One. People have been asking me a lot, does this change things? Does the budget change things? Should I be changing my financial planning strategy? At this stage, very, very speculative. And what we're actively encouraging our clients to do is to not panic. Not panic. Just a lot of it is speculation. A lot of the fundamental financial planning that I'm going to just show you in a second that we're doing still remains. Are pensions still relevant as they used to be if they get bought into your estate for inheritance tax purposes? Yeah, absolutely. And if anyone's going to ask that question in Q&A, please do. But I know that pensions becoming part of the estate for inheritance tax is quite a big talking point. And a lot of people are thinking, well, actually, this completely changes things. At this stage, pensions are still very, very valuable, and they're a very valuable part of financial planning. So I'm going to come on to that in a second. Just to, before I start, just because I am under Financial Conduct Authority regulations, we always have to have disclaimer slides. But in a nutshell, what it basically says is I am regulated by the Financial Conduct Authority, and anything that I say up here on this stage, if you want to call it a stage, is not formal advice. Okay, so if you want formal advice, please come and speak to me separately, and I'll discuss your situation. I actually do work with a few people in this room already, by the way, so some of you will have heard all of this before, but hopefully a lot of you haven't. So one of the first things that I talk about with people when they come to me for the first time and they say, right, Dan, how do I actually deal with financial planning? How do I plan for my retirement? How do I plan for my assets? Am I optimizing my tax efficiency? This diagram here, don't worry too much about the small print and the detail, but if you focus on the green boxes at the top, well, actually, they're not quite green actually on this background, but they are green on my screen anyway. These are the mainstream tax wrappers that are available in financial planning and actually do create the foundation for most people's financial planning. I haven't included things like enterprise investment schemes, venture capital trusts, which some of you might be aware of. But broadly speaking, these are the foundations for most financial planning. So we tend to start on the left-hand side. You've got pensions and ISAs. Okay, I'm sure you've heard of pensions and ISAs before, but these tend to be the bedrock for good quality financial planning, okay, because they're very, very tax efficient. And in the case of ISAs, they are fully tax-free. At the moment, one of the reasons why we tend to start with pensions is because they are held outside of the estate for inheritance tax purposes. Okay, so a key part of pensions is actually allows you to retain access of your finances, but actually move money outside of your estate for IHT purposes. Okay, very, very valuable. They also play a really key part as well. Anyone in this room who owns a business, pensions can be used to extract profit from the business in the same way that you do with salary and dividends. Okay, they create a really key part of financial planning for business owners. Pensions and ISAs work very, very well alongside each other. Okay, because you've got the tax efficiency of ISAs and you've got the estate planning side of pensions. Ideally, if you can get into a position where you've got the liquidity to do this, if you can have a combination of pensions and ISAs, when it comes to taking money out of your portfolio, okay, you can spread your tax allowances. And that's the key part of this diagram, is to say actually all of these tax wrappers have different tax treatment. So coming back to the budget, when we have things like capital gains tax, inheritance tax, being targeted, and no doubt dividend tax will be in there at some point in the future. I've got no doubt about that at all. Inheritance tax will probably get worse before it gets better under the current government. I think they've set their stall out on that one. One of the key parts of good quality financial planning is to spread your exposure, diversify. Okay, so holding pensions, ISAs, what we collectively call a GIA, a general investment account, for those who don't know, is just a non-ISA, non-pension investment account. Could be shares, could be funds, anything like that that is subject to capital gains tax and dividend tax. Okay, so if you spread your money between multiple tax wrappers, you spread your exposure. So if the government do come in with drastic changes to capital gains tax, or any of these taxes for that matter, pensions as well, if you can spread your risk between multiple tax wrappers, then you're putting yourself in a much stronger position. Make sense? Yep. Offshore bonds. Anyone come across an offshore bond before? Hands up in the room? No one? Yeah? People hear the word offshore and they think, oh, Panama, Cape Verde, dodgy, British Virgin Islands. But I'm not talking about those types of offshore investments. This is HMRC recognised, Guernsey, Isle of Man, Dublin in some cases, all declared to HMRC. But HMRC gives us different allowances with offshore bonds. So as part of a tax strategy, once we've utilised pension allowances, ISA allowances, once you've got capital gains tax issues, that's when we then bring the offshore bond into play. Now, the offshore bond now is becoming a much, much more key part of financial planning than it used to be. So it used to be really you needed about £1.5 to £2 million in your portfolio before we'd start bringing in the offshore bond into the equation. Now that's happening a lot sooner. And the main reason for that is the change to capital gains tax. At the moment, we've got 10% and 20% capital gains tax rates. That's going up to 18 and 24% for those who saw in the budget. Okay, so capital gains tax now is becoming quite punitive. I'm not going to talk about property and business assets because I think that's been covered by Joe and Luke already. But as part of a financial plan, property is something that we're seeing more and more people getting out of, investment properties. It's just becoming so punitive for tax purposes. And it's not even the financials of it either. A lot of people, when they get to retirement, it's the logistics of managing property. Having a bad tenant. I'm sure people in this room will have loads of stories about it. I hear more horror stories now than I do success stories when it comes to property. But I appreciate that some people, that's their thing. They like doing it. But anything that restricts access and liquidity and is punitive from a taxation perspective is something that we tend to avoid if we can. So properties are becoming less attractive, I think, as a result. So a couple of planning points, really. So I've only wanted to do this on quite a high level. There are lots of other things to talk about as well, but I think it's better to actually speak to someone like myself to do that if you need advice. But some of the questions I've been asked over the last week by clients is what I've put into this presentation, just to show you guys, just to preempt some of the thoughts that you might have had around some of the things that have come out. So national insurance contributions, just to start off with, I appreciate it's not ideal for if you're a business owner and employer, having a 2% increase to your costs. What's likely to happen though? Do you think costs are going to go up probably to cover that? Do you think prices of goods? Do you think employers are going to say, well, actually, if we've got a 2% increase to our wage bill, we're going to push our prices up to cover that? Yeah, I think so. And this is why we're seeing the Office Budget Responsibility talking about inflation. I mean, who would have thought it? Off the back of the pandemic and the Ukraine war, we were starting to get on top of inflation, weren't we? This is what the government were telling us. All of a sudden now, curveball gets thrown in, inflation's back on the cards again. And they're talking about interest rate rises instead of interest rate falls. It's insane, really, the position that we're in. But utilising things like salary sacrifice if you're an employee, or offering it to your staff. If you're an employer, offering salary sacrifice for pension contributions is quite a good way of mitigating national insurance impacts. Because, of course, anything that goes straight into a pension from an employer isn't subject to national insurance. Okay? Family investment companies. Something else that we're starting to talk about with a lot more people. So I've got a few clients that already do this, but setting up limited companies as investment vehicles allows you to move assets to different members of your family, for example. So it's something, again, if you need advice on this or if you think that this is applicable to you, come and speak to us. Capital gains tax. So some of this has been covered already, but declaring investment losses is really, really important now. Anyone who invests in the stock market will know that 2022, or 2022 should I say, was not a good year for investments, which is when inflation and interest rate rises were causing issues and downward pressure on the markets. If you do have any realised losses from previous years, 22 and 23 particularly, make sure you record them. Okay, so you've got 4 years to do that, but what it will help you to do is it will help to expand any capital gains tax allowances that you've got going forward, because anyone who's invested as well would also have seen that this year, 2024, has been a very good year in investment markets. So all of a sudden, we're now back in a position where all of those losses are being worked back. Offshore bonds, as I said, is another area that's exempt from capital gains tax and income tax as well, while the money is sat in there. There is no capital gains tax applied to an offshore bond. So one of the reasons why it's become such an important tax wrapper is because of capital gains tax issues. Okay. Spousal exemptions and deferring gains is also quite a key thing, which Joe's already covered, and utilising your ISA allowances as well. This is also the case, by the way, guys. I've had this a lot with people who've got large amounts of cash on deposit. Because we're now earning relatively good rates of interest on cash on deposit, people have forgotten that actually there's an interest allowance that we've got. So if you're a higher rate taxpayer, you're only able to earn £500 a year of interest before you start paying tax. If you're basic rate taxpayer or nil rate taxpayer, that figure goes up to £1,000. But if you're earning 5% interest, which is quite achievable these days, you only need £10,000 in deposit as a higher rate taxpayer, and you're breaching that allowance. All of a sudden, you're in a position where you have to declare your interest and pay tax on it. And that tax could be 40% or 45%, depending on your tax rate. So easiest way to mitigate that situation is use your ISA allowance if you're not already. Premium bonds as well, I've said to a few people, is quite a good way of getting £50,000 per person out of the tax system. Okay, so if you're holding in a cash environment, ISA allowances are very important, but you can also invest in the ISA environment as well, which is free of capital gains tax. Okay. Pensions. This is the one that I'm getting asked the most questions about. So if these rules come in 2027 and pensions become part of the estate for inheritance tax purposes, you need to be in a position really where you can react to that. Okay, that is going to change the landscape for pensions, and the need for financial advice, particularly alongside the work that the accountants do, is very, very important. Okay, but at the moment it's business as usual. You know, this is what we're saying about the media speculation. I don't quite know why the government saw the need to announce that they were going to be consulting about this. Why didn't they just do the consultation and tell us afterwards what they were going to decide? Instead, what's happened is that it's out there now that this is going to come in 2027 potentially, and people are panicking about it. So at the moment, I'm still encouraging people to utilise pensions and to carry on as if we were before, ultimately. But if it comes to a situation where inheritance tax treatment changes, then we need to react. Okay, but what we're not going to do is preempt based on speculation. So I would actively encourage you to do the same as well. For inheritance tax, there are other things to do. Pensions are still outside of the estate for inheritance tax under the current rules. Gifting, using family investment companies, transferring shares of businesses, all of these things that you can do to help with inheritance tax. One of the easiest ways to avoid inheritance tax, and the first thing that I talk to people about when they ask the question, spend the money. Spend the money. Then no one can tax it then, can they? But of course, I'm being facetious because, of course, we don't know how long we're going to live and all the rest of it. But as part of a good financial plan, we should be encouraging people to spend their money, enjoy it. If you've got inheritance tax issues and the money's in investments and liquid assets, spend it. So therefore, it's really important to understand, well, how much can you spend? So we do a lot of forward planning around this sort of stuff as well, a lot of cash flow modelling and understanding where people's parameters are. But spend the money. Spend it, give it away, put it into pensions. First three things I talk about with inheritance tax. Beyond that, that's when we start then bringing in trusts, AIM investments, all of those sorts of things as well, depending on people's situation. For corporation tax, anyone who's a business owner in the room, the first two things I talk about are pension contributions and life insurance. Believe it or not, these are tax-deductible corporation tax allowable administrative expenses through the business. They are not benefits in kind, and they are viewed as a form of profit extraction. Okay, so anyone who has a need for life insurance, do it through the business. Anyone who thinks that they've got surplus profits that they don't need as a dividend or a salary, pay into your pension. Okay, the first two things I talk about with business owners, really, really effective. Okay, so you get the corporation tax benefits in doing that, as well as all of the other tax benefits as well. Again, anyone who's in that situation, come and speak to me afterwards, or take a card off me or anything like that, and I'll talk you through it in more detail. We also have with pension contributions the ability to utilise previous allowances from the last 3 years. So it's something else as well. If you've got the cash available to do it, you can utilise that, particularly with business assets. Okay, and that's me done.